Did you get caught in the down move today? Were you surprised by the market sell-off? Our members were not surprised. Not only were they not surprised, they were in position to protect their long portfolio and to exploit the down move. Let me explain and introduce myself. I'm Bagadon at StockMarketCaddy.com. Today is Thursday, February 25th at 4:48. Now, we have been showing these tools to our members for months, but particularly for the last couple of weeks. Let me explain to you what you're looking at. This is the Swing Machine. The Swing Machine is a very unique proprietary software package running on TradeStation's product called Radar Screen. And it can run on anything and everything. Now, these are the yields. The yields. This is 13-week, 90-day paper, 5-year paper, 10-year treasuries, 30-year treasuries. These are actually the yields, but the way they report this is you have to actually move the decimal over. So the yield on 90-day paper is actually not 0.33 basis points, it's 0.03. The 5-year isn't 8%, it's 0.805. The 10-year isn't 15%, it's 1.518. And the 30-year is 2.308 basis points. That is the yield. Rising yields, uptrend. Now, let me just share with you what's taking place. 134 days ago, Swing Machine picked up on the rise of yields on the 30-year. The entry price, it went long the yields at 1442, but it's really 1.442 is the yield. And it's been long ever since. The entry price has gone from 1.442 to 2.308, 866 basis points. The 10-year, which is most notable, went long at it says 6, but it's really 0.677 basis points. And it's been long ever since. Look what's happened. It's now at 1.5, almost 2.5 times where it was just 102 days ago. The 5-year went long 35 days ago at 0.432. Look where it is now, 0.802. It's nearly doubled. The problem is, folks, yes, the short-term rates are pegged to the floor by the Fed, but the long-term rates are rising and rising rapidly. Are they losing control? This chart down below shows us graphically what's happening. Back in February of last year, when now this is the 90-day paper. The 90-day. This is the rate that they think they control. When the markets were crashing last February, the Federal Reserve pumped in liquidity. And when they did, the yield curve, this is the yield curve. This is the difference between 90-day paper and 10-year paper. It really widened out. It basically helped the banks and it flooded the system with liquidity. And it's been smooth sailing ever since until right in here. And what's happened is, with no input from the Fed, the yield curve is rapidly increasing. It's rising too far, too fast. It's overheated. And if the Fed doesn't take action, it could really get out of hand. What does that mean for equities? They're screwed either way. If the Fed steps in to cool this down, equities are going to get hit. If the Fed doesn't step in, equities are going to get hit. I'm Bag of Don at StockMarketCaddy.com. If you want to learn how this game is played and you want these tools to sit on your desktop, so that you can learn to trade your game, we're here for you. We don't hand out the fish. We don't make specific recommendations to buy or sell anything. We teach you how the game is played so that you can learn to trade your game. Once again, if you want to reach out to us, my phone number is 813-758-8263. This is just one snapshot of the algorithmic tools that we have built. We teach you not just how to use these tools, but how to use them in combination. You will depend on no one. You will depend on yourself. You will learn to track money flow on whatever it is. ETFs, the individual stocks, futures, interest rates, treasuries. It can't get by you. It can't get by us, and it can't get by our members. Feel free to give us a shout. Today's lesson of the day: yield curve rising too fast, overheated, too steep. Something's going to break. Most likely equities. And quickly hunker down, buckle up.